Wall Street just closed out the first half of 2026 with the magnificent seven stocks sitting in the red for the year, even after Meta popped 8% this week on an AI cloud deal and Nike beat earnings. So on the surface, everything looks fine. But underneath that surface, a specific number keeps showing up in trading rooms and economist reports, and that number is 2027. Prediction markets on Kalshi are pricing recession odds for 2026 at just 17.5%, the lowest reading on record, and that's the calm part. But for 2027, those same traders put the odds at 41%. Not a coin flip, but close enough to make people nervous, and the gap between those two numbers is the whole story. It means the smart money doesn't think the crash happens this year. It thinks the bill gets paid next year. David Rosenberg has been early on this call since 2022, and he's not backing off it now. Rosenberg, who runs his own research firm and spent years as chief economist at Merrill Lynch, said the U.S. economy could tip into what he called a very significant recession sometime in 2027. And his logic comes down to two engines running out of fuel at the same time: government stimulus and AI spending. On stimulus, Rosenberg is watching the midterms this November, because if control of Congress shifts, gridlock becomes the default setting in Washington, and the kind of fiscal support that's been propping up growth becomes what he calls a no-show in 2027. On AI, the math gets even starker, since Amazon, Google, Meta, and Microsoft are projected to spend close to $600 billion combined on AI infrastructure this year alone. And Rosenberg estimates that spending has driven something like 90% of all economic growth recently, once you account for how much of the stock market's wealth effect is really just tech valuations. That kind of spending doesn't scale forever. The capex cycle peaks eventually, and when it peaks, Rosenberg thinks it peaks in 2026, right before the stimulus runs dry too. Jamie Dimon has been saying something similar in his own way for over a year now, and the JP Morgan CEO isn't talking in the abstract when he warns about storm clouds building in the credit markets. Every quarter, the Fed puts out something called the Senior Loan Officer Opinion Survey, which basically asks banks whether they're making it harder or easier to get a loan. And when that report shows banks tightening standards, it means banks are scared they won't get paid back, which stops businesses from opening, expanding, or hiring. Credit is oxygen for an economy, and cut the oxygen and everything downstream slows down, usually with a lag of a year or more before anyone feels it. That lag is the part almost nobody talks about, and it's the reason 2027 keeps coming up instead of 2026, because monetary policy doesn't work in real time. Paul Volcker learned that the hard way in the early 1980s when he pushed interest rates up toward 20% to kill inflation, and the recession that followed didn't hit immediately. It hit after the tightening had already been sitting in the system for months. Today's version of that lag means rate decisions made now might not show up in the real economy until 2027, and the Fed is stuck threading a needle where cutting too early brings inflation roaring back, while waiting too long tips the whole thing into contraction. Nouriel Roubini, the economist who called the 2008 crash before almost anyone else believed him, frames it differently, talking about something called stall speed, which is the point where growth slows down so much that almost any shock, a war or an oil spike or a bank failure, is enough to push the economy into an actual downturn. The scary part about stall speed is that it's invisible until it isn't, and GDP can look technically fine right up until the moment it doesn't. And there are real numbers backing up the unease, not just theory. A Bankrate survey of top economists found that over 94% of them think inflation won't hit the Fed's 2% target until at least the end of 2027, with nearly half pushing that out to 2028, while mortgage rates sit around 6.35%, and energy costs have jumped double digits year over year. Consumer sentiment, according to the University of Michigan's index, recently hit the lowest point in its 75-year history, even while the stock market was hitting new highs. And that disconnect between record highs on Wall Street and record lows in how people feel about the economy is exactly the kind of gap that shows up right before things break. There's a market signal worth watching too, a lot less exciting than a Fed announcement, but one that tends to move first. The Russell 2000, which tracks smaller companies, usually feels pain before the giants do, because small companies don't have the cash reserves that Apple or Microsoft can lean on. So when credit tightens or demand softens, they're the ones that show it first. And watching that index against the S&P 500 tells you something the headline numbers won't. So does that mean 2027 is locked in as some kind of Great Depression sequel? Not exactly, and it's worth separating the words being used here since they get thrown around loosely. A recession is a normal, almost routine part of the economic cycle, painful, but temporary, while a depression is a different animal entirely, deeper and longer and rarer, the kind of event that reshapes how an entire generation thinks about money. Most of the economists sounding alarms right now, Rosenberg included, are talking about a recession, a serious one, but a recession and the depression language tends to come from more extreme corners of financial media looking for clicks rather than from the people actually running the models. What almost everyone agrees on is that the setup for 2027 looks different from a normal cycle, with a fiscal cliff tied to a specific political calendar, an AI investment boom that has to slow down eventually because no capex cycle runs forever, inflation that refuses to fully cooperate, and credit standards tightening quietly in the background while headline numbers stay calm. None of these alone would be enough to trigger a serious downturn, but stacked together in the same 12 to 18-month window, that's a different story. The honest answer, the one none of these economists will actually give you with full confidence, is that nobody knows for certain, and anyone who tells you they do is selling something. What the data actually supports is more modest than a prediction. It supports preparation. Rosenberg isn't telling people to panic, he's telling them to notice that two of the biggest supports under this economy have expiration dates, and those dates both land around the same year. And whether that turns into a mild slowdown or something closer to 2008 depends on decisions that haven't been made yet, by the Fed, by Congress after November, and by companies deciding whether to keep pouring hundreds of billions into AI data centers or finally pull back. There's also a piece of this that rarely makes it into the headlines, and it's about how these things actually unfold once they start. Nobody in 2007 was walking around saying Lehman Brothers by name, even though economists had tracked housing bubbles and subprime lending for years, and the warning signs were sitting right there in plain view. Yet almost no one predicted that a single investment bank collapsing on a Monday in September would wipe out close to $11 trillion in U.S. household wealth within months. That's the uncomfortable truth about downturns. The broad conditions get forecast reasonably well in advance, but the actual trigger almost never does, which means the honest way to think about 2027 isn't as a date on a calendar where a bell rings and the market crashes. It's a window where the underlying support structure gets weaker, and weaker structures break for reasons nobody sees coming until after the fact. That's also why watching a single number, like the Kalshi odds or one Fed survey, misses the bigger picture, since industrial production tells you what factories are actually making in real time instead of relying on a GDP number that gets revised months later, and initial jobless claims, released every single week, tend to be the last domino to fall. So a sudden uptick there rarely surprises anyone who was already watching credit and small caps months earlier. None of these signals are flashing red on their own right now, and some analysts even argue that shadow lenders, the private credit funds operating outside the traditional banking system, have enough dry powder sitting on the sidelines to keep businesses funded even if regular banks pull back, which is the case for cautious optimism, and it's a real one. 2027 isn't a prophecy, it's a deadline that a handful of very smart, very well-paid people keep circling on their calendars. And what happens when that deadline arrives is still being written by decisions in Washington after November, by whether AI capex keeps climbing or finally cools off, and by whether the Fed threads a needle it hasn't managed to thread cleanly in decades.